Welcome back. In our last explainer, we dug into the why behind IFRS 18. The end of creative profit reporting. But today we're getting incredibly practical. If you're an accountant, an analyst, or a CFO, listen up because these are the specific day-to-day changes that are going to be hitting your desk very soon.
Welcome to IFRS-LABO. Consider us your personal guide, taking you from high-level general theory straight into in-depth practical know-how. I am absolutely thrilled to walk you through what is, honestly, a monumental shift in our industry today.
So our main goal right now is to cut straight through the noise and hand you exactly what you need to survive this new operational reality. We're going to cover the new mandatory structure of the P&L, the incredibly strict new rules for handling your custom metrics, and, maybe most importantly, the hidden 2026 compliance timeline you absolutely have to follow to avoid some pretty severe risks down the line.
Here's our blueprint for today. We'll look at the core structure, then master the new P&L, dive into MPMs, which I like to call transparency with teeth, and finally, we'll unpack that 2026 comparison trap.
All right, let's jump straight into part one, the core structure. It's a completely new framework.
Now, it is absolutely vital to understand that IFRS 18 isn't just a tiny update. It's an entirely new, comprehensive framework. Think of it as a mental map. It starts with general requirements based on materiality and then drops right into strict rules on how you group or split your data. Aggregation and disaggregation. But the real heavy lifters here, those would be the new rigid categories for the statement of profit or loss and the updated notes section. That's the part that officially drags your custom non-GAAP measures right out into the light. Moving right along to Section 2, Mastering the New P&L. Let's look at the visual translation of these rules. Okay, this is where the standard gets incredibly real for your day-to-day reporting. This is the mandatory IFRS 18 P&L structure. Every single income and expense item now has a highly specific, mandated home. Honestly, if you're in the field, you need to memorize this format right now because it entirely removes that old freedom companies used to enjoy, shifting items around just to make the core business look a little bit better on paper.
So what exactly are these new homes? Well, we've got three primary buckets. First up is the investing category. These are returns from assets generated independently. Think joint ventures or associates. Second is financing, which catches the costs of raising capital, your interest effects, things like that. And finally, we have the operating category. Now, what's really fascinating here is how the rule makers actually defined operating. They didn't bother writing some exhausting 50-page definition. Instead, they defined it by exclusion. It's a residual bucket. You essentially take all your income and expenses, surgically remove the financing and investing pieces, and whatever is left over, bam, that is your operating category.
The absolute crucial takeaway here is that operating profit is now a globally standardized, mandatory subtotal. For the very first time, this takes all the guesswork out of the equation. By permanently stripping away management's ability to just selectively define what counts as operations, it gives analysts and investors a true, reliable, apples-to-apples comparison between any two companies anywhere in the world. It's a total game changer.
All right, let's pivot to Section 3, MPMs, or as I like to say, transparency with teeth. Now, while the new P&L is super rigid, the rulemakers do understand that management still has a unique perspective they want to share. But first, let's nail down exactly what we're talking about here. Management performance measures, or MPMs, are those custom subtotals, like an adjusted EBITDA or a core profit, that management uses in public communications to reflect their specific view of the company's performance. Bottom line, if you stick it in a press release or flash it in an investor presentation, it is now an MPM.
And the shift here is just massive. Think about the old way of doing things. You could essentially freely drop custom profit numbers into a press release or a slick PowerPoint deck, get the market all focused on them, and pretty much just walk away. But the new way? Oh, it's completely different. Those custom profit numbers are now subjected to incredibly strict disclosure rules, living right inside the formal, audited notes of your financial statements.
So if a company actually wants to use an MPM now, they've got to follow three major new rules. Rule number 1, location. It absolutely must be in the audited notes, not just in some flashy press release. Rule number 2, reconciliation. You literally have to visually bridge your custom number directly back to the closest official IFRS subtotal. And rule number 3, explanation. You have to clearly explain exactly why this metric is useful and exactly how it's calculated. And let me give you a fair warning. The rules here are strict. If you change how you calculate an MPM from one year to the next, you have to explain why. Consistency is absolutely no longer optional.
Let's walk through a practical example of what that reconciliation actually looks like. Say management really wants to highlight a flashy adjusted EBITDA of $1,200. Well, under IFRS 18, they have to lay the whole thing out. They have to explicitly show the $300 in depreciation and the $100 in restructuring costs that they backed out to clearly bridge down to the official heavily regulated IFRS operating profit of $800. It just forces total transparency. The days of black box calculations are officially over.
Moving on to our final major section, Section 4, the 2026 Comparison Trap. This is the hidden timeline you need to watch out for. Now, the official effective date for IFRS 18 is January 1st, 2027. But whatever you do, do not wait for 2027. Because you are required to provide comparative information for the previous year, you actually need to have your systems completely ready to track data under these new IFRS 18 rules by January 1st, 2026. That is your transition year. You'll be essentially running 2 sets of books for that comparative period.
And because of that sneaky accelerated timeline, the impact of this standard is going to ripple through your entire organization. We are not just talking about giving the accounting department a headache here. Think about the domino effect. If the official definition of operating profit changes, suddenly you have to redesign executive bonuses that are tied to that profit. You have to completely reevaluate your internal KPIs, and yeah, you're going to have to execute some major updates to your IT and financial software systems. All of this elevates IFRS 18 from a simple compliance checkbox into a massive, company-wide strategic challenge.
So, to wrap up this explainer, IFRS 18 is a truly major reform. We have officially moved away from general historical practices straight into highly specific format requirements. The era of creative profit reporting, it's done. It's been replaced by a system built from the ground up for pure comparability and beautifully structured data.
I want to leave you with one final thought today. In this entirely new world of forced transparency and rigid comparability, how will your team define, measure, and communicate your performance to the market? Because make no mistake, this isn't just some dry accounting update. It is a fundamental question of business strategy. So start planning right now because that 2026 transition year, it is right around the corner.